Smaller banks who've been hit with a credit rating cut have called on the regulator to retaliate. Ratings agency Standard & Poor's downgraded more than 20 smaller banks, citing increased risks of a property price collapse. The major banks are protected by an implicit government too big to fail benefit, retained their ratings. An angry Bank of Queensland boss says the banking regulator should impose even tighter capital controls on the biggest banks to level the playing field. Here's finance correspondent Philip Lasker.
The smaller banking players had barely tasted victory after the government slapped a levy on their bigger rivals when they were hit with a credit rating downgrade.
Their cost of wholesale funding is going to rise, and their wholesale funding costs are already very high, so they don't need another disadvantage being added to the pile of disadvantages that they have.
The biggest banks, protected by a too big to fail implicit government guarantee, have not been downgraded. The reason for downgrading the 23 smaller players is the 15% plus price increases in both Sydney and Melbourne and the accompanying uncomfortable rise in household debt, which is around 136% of GDP, up from 117% 4 years ago. But there are two things that give Standard & Poor's comfort: the prudential regulator's restrictions on lending and a big increase in apartment supply in the pipeline.
Those two measures primarily make us believe that that momentum should turn. In addition, we also draw on the past track record in Australian property markets, where these cycles unwind in an orderly manner rather than resulting in sharp corrections.
Many property owners in Queensland and Western Australia might beg to differ, but Standard & Poor's even regards those markets to be unwinding in an orderly manner. The Bank of Queensland was downgraded by 2 notches. Its boss is ropeable.
Well, BOQ is in really good shape. Our balance sheet is in the best shape it's been in over the last 5 years, and we have one of the highest capital ratio levels of any bank in Australia. What is perplexing is the fact that the 4 major banks did not have a credit downgrade.
And John Sutton says his business shouldn't be lumped in with some of the other lenders.
Our market share, particularly in key markets that S&P are worried about, Melbourne and Sydney, we actually have very, very small exposure into those key markets. So it doesn't make any sense at all in what S&P has done.
But the ratings agency maintains that if there's a sharp correction in Sydney and Melbourne property prices, direct exposure is irrelevant.
In our view and in our experience, when such a scenario does take place, typically almost all parts of the economy and all geographies within a country are impacted to a high degree. Therefore, regardless of whether a financial institution in the country has direct or indirect exposures to some cities where a price appreciation may or may not have taken place, they would be impacted in a significant manner in that scenario.
So the smaller players will be forced to raise more money through deposits.
Most of their funding comes from deposits at the moment, but if they are to have their loan growth constrained by deposits, which is what this downgrade is going to lead to more being the case, then the loan growth will necessarily be a little bit less.
But BOQ doesn't see any short-term damage.
The impact for us is not in the short term. It may be in the medium term when we come to roll over some of that wholesale debt. However, we'll always continue to maintain our competitiveness in this market.
An increase in the government's bank levy might help level the playing field, but that's not what the Bank of Queensland boss wants.
What I would be advocating is to level the playing field is around what APRA's view is around unquestionably strong and further capital raising that may be needed for the big 4 banks rather than the levy.
The smaller banks will just have to grin and bear it for now.
Philip Lasker there. Well, the sale of mortgage bonds in Australia has more than doubled in the past year, despite warnings about a housing bubble. Data compiled by Bloomberg shows a borrowing binge with $10.5 billion worth of mortgage-backed securities issued so far this year. That's up from just over $5 billion a year ago. Well, the downgrade has taken immediate effect on smaller banks' funding. One small lender reportedly saw a jump of 0.5% as soon as the news of the rating downgrade hit yesterday. It's making the problem of rising funding costs for banks more acute and will have an obvious impact on households. Charlie Jamieson from Jamieson Coote Bonds joined me in the studio. Charlie Jamieson, what is the material impact on those institutions that saw the downgrade from Standard & Poor's?
I think, look, initially it's going to be higher cost of funding. So that's probably borne out by borrowers having to pay a little bit more because banks are going to have to pay more to source those funds. We saw yesterday there was a deal in the market launched before the downgrades, and that deal was repriced 50 basis points or 0.5% higher after the downgrades. And so it's not a good sign for future borrowers. They're probably going to face increasing costs of mortgage funding.
So that was a lender that went to the market looking for funds in order to, then loan that money to people wanting to borrow for a home or a business. So that's going to pass straight through.
It's likely to pass straight through. Clearly, the cost of these funds as financial institutions procure them needs to be recalibrated as to what levels they can then re-lend to the greater public. And if those costs are going up, like we've seen with out-of-cycle mortgage rate hikes from the Federal Reserve, rate hikes in the United States in December and in March of this year, passed on by the big four Australian banks, it's very likely that mortgage rates are going to be pushing up for a period, which is in stark contrast to what we've seen over the last 5 or 6 years, where many borrowers have enjoyed lower and lower mortgage rates through that time.
So that just really puts the big four at an immediate advantage over those 23 smaller lenders that were downgraded if they are already and immediately facing high borrowing costs.
Yeah, it does. They were excluded from the downgrade by virtue of the fact that there is an implicit type guarantee through to the federal government, and it does put them at advantage as it comes to sourcing funds. We clearly have some concerns that as the Federal Reserve in the United States continue to raise interest rates as they've widely telegraphed over the year, their next meeting where they're expected to raise is in June, that we'll see further out-of-cycle mortgage pressures in Australia. And that comes at a time when wages growth remains very, very weak. And it's as people's outgoings continue to climb, they're not being able to offset that by asking for wage increases. So
to turn to that offshore market where we source a lot of our funding, particularly is in the US, what are you seeing in the bond markets there where the banks go to borrow money?
So the banks still will source a large portion of their loan books from those international markets, around about 30%, but it changes a little bit institution by institution. And clearly after a Federal Reserve rate hike where they've put the cost of money up, to go and source funds in those markets becomes more expensive, and that's why the banks are passing that through. They are not in a position where they will absorb that margin pressure, and they do pass it through to consumers in the face of higher variable mortgage rates. So we would continue to, or expect to continue to see that over the course of this year, putting pressure on the market, I guess, at a time when, for the last 5 or 6 years, we've enjoyed broadly lower and lower mortgage rates in Australia, combined with a scenario where we've had fairly easy credit creation. And both of those things have seemingly turned now and become mild headwind.
I mean, and how significant are those increases in the borrowing rates that we're seeing at that institutional level? We've been expecting to see the Fed Reserve raise for some time. Has it already been priced in, or you're expecting more increases?
I think with regard to the Federal Reserve, the markets had grand expectations at the start of this year that there would be a whole series of Federal Reserve rate hikes. I think as it's come to pass, Mr. Trump, President Trump, has struggled to implement his legislative agenda, and there's certainly been some frustration and delay. There's obviously a lot going on politically in the US at the moment around their potential obstruction of justice charges. And so it does look like a lot of that legislative impetus, which would provide growth for the economy, will be delayed, and that can probably slow the Federal Reserve to some degree. So we've generally seen bond markets perform very well over 2017. I guess that wasn't the central expectation of many strategists and economists, but we felt that the Trump agenda would always be somewhat frustrated and delayed by virtue of his inexperience in the political sphere.
Do you expect that it's possible that Australia will be caught in a very awkward position, that internationally we're seeing the cost of funding continue to rise while we're seeing the Australian economy slow, household debt remain extremely elevated and wage growth remain extremely low. So what does that mean for the economy? Like, can the RBA offset that?
Look, we don't think the RBA will do anything over the course of 2017 or 2018. They're very unlikely to hike interest rates because mortgage borrowing costs are doing that by market forces. They're very unlikely to probably cut without some kind of existential crisis. So we feel that they're very benign, but clearly the price of mortgage money is likely dictated by international factors for Australians. And that comes at a time when, as you've mentioned, household debt has never been as high. Interest rate sensitivity has never been as great. And so these, albeit small but incremental hikes in mortgage costs, do have a material impact. It's something that does take time to come into the economy. I guess we've seen 2 negative retail sales numbers in a row now, so that increased outgoing by via of higher mortgage costs is maybe feeding through into the retail space a little bit. We also have grave concerns that building permits are down considerably year over year. Now, you cannot move into construction without a permit to build, and so building permits become the back part of the construction pipeline. And with less projects coming online, we know 9% of Australians are employed in the construction industry, and we have concerns that they might not have projects to move on to, which is why the infrastructure program by the government becomes so important, to put up good projects for people to be able to transition to in time. So, we're still seeing great interest in the bond market.
Charlie Jamieson, it's been great to have you on the program again. Thanks so much for your time.
Thanks a lot, Elise.